Let's get more on this market weakness. We're joined by Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Diana, thank you very much indeed for joining us.
Morning, Andy. Thanks for having me.
What's your feeling in the market? Are you getting a feeling of fear and nervousness that this AI thing has been overdone?
Definitely, we can see the CDS spreads are blowing out. I think it all started when they started raising debt. And we had Amazon raise more debt yesterday, and the demand for that debt has been multiple times covered. So it's not like people don't want to have access. And let me just add in, just for context, the NVIDIA earnings tomorrow. We're expecting 57% growth on the top line and 55% growth EPS and 73% margins. So it's trading at 30 times next year's earnings. I just want to say this so that we can have a context as to how big the numbers are, and it is 10% of the NASDAQ 100 and 8% of the S&P. So, yeah, it's normal and probably healthy what's going on right now in terms of the little check back. The market is having a little bit of a tantrum. There is a little bit of a pile on of negativity, and definitely breadth, which we watch very carefully, has been deteriorating in the last few weeks, which for our tactical active strategy meant that as stocks break down, we just leave it in cash. We're in a no-buy zone. And one other point before we move on to another question is you really have to mind your time horizon. If I'm talking to the short-term traders right now, they're going to stay away until this stabilizes. But for the longer-term investors that, put money in their RSP every month, that strategy should not change.
It's interesting you mentioned the debt that these tech companies are taking on. There's a headline on Bloomberg: AI debt supercycle isn't nearing the end, likely just beginning, because the AI capex is projected to soar towards $3 trillion US over the next 5 years. And debt is becoming the funding tool of choice. As you mentioned, Amazon, other tech giants issuing bonds.
Yeah. And, the other thing that seems to coincide is when JP Morgan reported a few weeks ago, when the US earnings season just started, they mentioned one investment that went sour. And the market and traders are split camps almost evenly, whether that is something more substantial to watch, because Jamie Dimon said that where there's one cockroach, there could be more cockroaches, and that's certainly true. But there are those that think that this was a one-off, and there are certainly sometimes not so great investments. But, when you look at the larger spreads like the IG and high yield, investment grade and high yield spreads, it moved up slightly, but not substantially. And, the other thing that is kind of triggering a little bit of fear, and now there is a pile on of negativity, of course, because everybody's watching the yields on the Japanese bonds moving up and how that might suck money out of the North American market or the U.S. Treasuries. But we've seen U.S. Treasury buying as well. So, the facts don't always match up exactly to the potential narrative. And yes, we might have a little bit of a tantrum on the carry trade that everybody's watching. So, again, this could be healthy. We're coming into this today with about 20% cash because, as I've mentioned, as breadth deteriorates and if stocks move down, we tend to be very disciplined sellers. So, when gold started trickling down, we've gotten out of the golds. We have since, and we booked nice profits, but we have since added them back in a little bit to a certain extent, like maybe 3 to 4% of portfolios. We've also taken some profits in Celestica, did not sell it out, just brought clients back to a regular weight from a high weight. So it ebbs and flows, and we ebb and flow with it.
So CLS, let's put up a one-year chart there. You're not out of CLS because they built a wonderful franchise, it seems, in installing data center equipment.
It really is. And then, you have to have some growth in the portfolio. And this is where the growth in the Canadian stock market exists. So we'll see. We'll see if it breaks down. We're of the opinion that we let pricing and the market tell us what to do. If it breaks down, we'll take it further down, and there'll be opportunities to get back in. So we manage this. I guess this is not about return right now. I guess this is about risk management. And again, if I'm talking to short-term traders, they know exactly what I'm talking about. This is not the time to step in, but there will be a better feel to step in, to add to positions or to initiate new positions. So for now, it's a no-buy zone. We will watch, we will re-engage, like say NVIDIA tomorrow reports and let's say legitimizes all this AI fear and gives us another leg. We will re-engage, but should it not? And I mean, lately the volatility around NVIDIA's earnings has subsided. We are pricing in about, the options market's pricing in about 6% move tomorrow for NVIDIA. But, we used to have a lot more. And lately the stock hasn't really been moving all that much given its size. So we'll see. Everybody's watching. And maybe perhaps people are worried with the government in the U.S. reopening. We're going to have a pile-on of economic data. And there's been lots of talk about softness in the labor market. But we've had ADP came in line, and we've had jobless claims came in this morning early. It was benign, and Canadian inflation is at 2.2%. So it's kind of okay. And if this is healthy, it's a good check back.
Dana, we better jump. Thank you very much indeed for joining us. That's interesting. You're not buying stocks right now, or you're saying it's about risk management.
It's about risk management right now, and we're not buying until it settles down.
Diana, thank you very much. Diana Avigdor, VP and Portfolio Manager and Head of Trading at Barometer Capital Management.